All right, let's talk about ServiceNow. Here's a company that's an absolute giant in the software world, but it's facing this really fascinating problem where its biggest opportunity, AI, might just be its biggest threat too.
So here's how we're going to break it all down. We'll start by looking at just how strong the company is right now. Then we'll get into that core conflict with AI. We'll explain exactly what this paradox is, see what Wall Street makes of it all, and wrap up with the big dilemma facing any investor looking at this stock.
Okay, so first things first. Let's just look at how incredibly well ServiceNow is doing on paper, based on their recent results.
Check this out, a whopping 21% growth in revenue. I mean, for a company this big, hitting that kind of number shows some serious momentum. And it's not just about making money, it's about how efficiently they're doing it. Their free cash flow margin shot up to almost 35%. That's a huge leap, and it shows this isn't just empty growth, it's super profitable.
And you can see this trend line, right? It's clearly pointing up. They hit an operating margin over 31% last year, and they're actually expecting to do even better. They're getting leaner and meaner, even as they're getting bigger.
So, what's the bottom line here? The company is basically telling everyone, hey, the party's not over. They're looking at another year of nearly 20% growth while also getting more profitable. You know, for an investor, that's pretty much the dream scenario.
Okay, so everything looks fantastic, right? Well, scratch beneath the surface, and that's where things get complicated. A huge tension is building, and it's all because of AI.
And it all boils down to this one simple truth. The whole point of AI for a customer is to get more done with fewer people. And that right there, that's the core of the problem for ServiceNow.
And this leads us right to the central idea, this concept that we're going to call the AI seed paradox.
So what is it? It's pretty simple, actually. ServiceNow's whole business model is built on selling subscriptions for each user, a seat. But their shiny new AI tools are designed to make companies so efficient that they might not need as many users. You see the conflict here? They're selling a product that could shrink their own customer base.
Let's put these two models side by side, because this really spells it out. The old way on the left, simple. A customer hires more people, ServiceNow sells more seats, and revenue goes up. But the new AI world on the right, it flips that completely on its head. It's all about doing more work with fewer people, which leaves a giant question mark right where the revenue growth should be. So what's their game plan? How do they get out of this jam? Well, they're making a big shift. They're starting to move away from just charging per person. Instead, they're bringing in what's called consumption-based pricing. The idea is you don't pay for the person, you pay for the AI's action. Every time an AI agent ticks off a task, that's what you get charged for.
Now, this new model isn't some magic bullet. On the one hand, yeah, it makes a ton of sense. The price is tied directly to the value you're getting. But, and this is a big but, it's got some major downsides. Your revenue suddenly becomes way less predictable. I mean, it's not a steady subscription anymore. And all the computing power needed to run that AI, that costs money. And it can start to squeeze those amazing profit margins we were just talking about.
So this all leads us to the million-dollar question, right? Is the ServiceNow growth story over? Could the very thing that's supposed to be their biggest advantage, AI, actually be the thing that brings it all to a halt? But, if you ask the folks on Wall Street, the answer to that question is a loud, clear no. Let's take a look at what the analysts are saying.
So despite this whole paradox we just laid out, this fundamental conflict in their business model, the consensus price target from analysts suggests, get this, an 86% upside. That's not just optimistic. That's an absolutely massive bet on the company.
And hey, just so you know, this isn't based on some old, outdated numbers. Even the analysts who updated their targets right after the latest earnings report are still incredibly bullish. They're still seeing around 75% upside. Wall Street is clearly convinced that ServiceNow has this figured out.
And this is what creates such a fascinating puzzle for any investor. You're trying to weigh what's happening right now against what could happen in the future. So let's really put the two sides against each other. In one corner, you've got the bull case. I mean, look at those financials, and their new AI product is growing like crazy. But in the other corner, you have the bear case, and it's a heavyweight. It's all about that big, scary AI seat paradox, the risk that their main business slows down, and, the constant worry about what competitors are up to. The thing to really take away from all this is that it's not just a ServiceNow story. What's happening here is like a sneak peek, a preview of the challenge that pretty much the entire software industry is about to face. They're the test case for how these established giants will handle the AI earthquake.
And that leaves us with one final big question to chew on. When a company's biggest innovation is also the biggest threat to its own tried-and-true business model, where do you put your money? Do you bet on the shiny new technology to win out, or do you bet on the resilience of that traditional business? It's a question the whole market is grappling with right now.